everyone. My name is Ayesha Kiani. I head business development and LedgerPrime. This is actually my third Ethereal Summit. I still remember the first one very much vividly, but not to take anyone's time any further, I wanted to quickly dive in and start on what I'll be talking about today. So, well, first of all, thank you so much, Travis, for giving me this opportunity. When he and I had the conversation, I wanted to talk about the growing market of ETH options because I had newly joined a hedge fund, LedgerPrime, and at that time, Bitcoin options, Bitcoin futures, was the talk of the market, but then there were slowly ETH options emerging in the market too. But knowing that consensus is, the Ethereum forward, at ETH Denver, I was very surprised to see that, there's not as much talk of another form of trading that has been, in traditional markets for, good 30 to 40 years or so. And that kind of like provides the hedge to companies, to traders, and protect downside. So that's why I wanted to bring up derivatives today. And then, I'd also discuss on how, the crashes have happened on March 12th and around that, and how crypto was able to survive because the downside that's provided by derivatives in many forms and shape. So okay. Yes. Okay. Awesome. So, as far as LedgerPrime goes, we are a quantitative hedge fund. We are owned by the same holding company as LedgerX, which is a derivatives exchange. LedgerX was formed 5 years ago. We've been around for almost a year and a half. We primarily trade options using quantitative and systematic investment approach. Targeting steady capital growth and superior risk adjustments. We also provide our investors a low volatility exposure to digital asset markets via quantitative and systematic strategies. We also market make using consistent and predictable market liquidity and provide market depth, with narrow spreads and transparent price discovery, which allows our investors and participants to trade more efficiently. So, like, as I started off my presentation, that the entire crypto ecosystem is still like very much a dislocated ecosystem. Given that what we're doing at this point. So, what we see on a given day is like derivatives exchanges are highly leveraged. They're leveraged at up to 125 times, on most given days. Liquidation and margin calls on these derivative exchanges are often instantaneous. Movement of funds or crypto are not, especially during times of market distress as mempools get clogged. There's no comprehensive prime broker, central clearinghouse, or cross-platform margin, which means that a trader could have a long position in one exchange and short on the other one, which could get liquidated. And then the other thing, as most of you know out there, is that most exchanges still take crypto as collateral. So which means, if the BTC value is down, your collateral value is going to go down. And there's no circuit breaker of exchanges. The reason I wanted to bring this up is that on March 12th, that was our fund, Multicoin Capital, for instance, because they published a very comprehensive report on it, started saying that how there's some traditional infrastructure that's crypto also needs from the traditional asset markets. So I also wanted to bring up a certain point that this is the current like CeFi system, as I know that there's a separation now, DeFi and CeFi, and we all know that Bitcoin and Ethereum networks in their current forms cannot operate at global scale as much as we would like it to be, as much as we would want Ethereum to, be traded, on all exchanges and whatnot, or be even accepted as a currency. Uh, that kind of volume at any given day could always clog the system, and that's a glimpse of it we only saw on March 12th. But the other thing is that this is something that we need to be cognizant of if we are working on our current infrastructures and trying to make it more of an adaptable market going forward. So what happened was, like, during times like of in crisis, they become so congested that arbitrage cannot keep prices in across all venues, causing massive dislocations. And certain dislocation particularly happened on March 12th, where Bitcoin dipped down to almost $4,000 for 15 to 30 minutes. And it wouldn't have happened if markets would have operated correctly. Um, so what really happened? Like, I keep talking and talking about, like, March 12th. Um, Basically, on March 12th, it was the last end of the domino effect, right? Like the last, like, just the last block of domino effect just going down. So miners, lenders, and speculators had all leverage long leading up to this date, partly because we were in a semi-bull run. Like, January and February had been good months on our end. And the drop in crypto markets in the previous week as a result of global market turmoil, oil prices dip, and then finally US acknowledging, the existence of COVID-19, began to reach loan market margin call levels. And as a result, lenders started to liquidate crypto collateral aggressively to protect themselves, which caused aggressive selling. I'm not calling out only crypto markets here. Yes, we do know that, all traditional asset markets, there was a global sell point, but beware of the fact that on any given day, New York Stock Exchange, if trading goes below 7%, there's a circuit breaker for the markets to adjust correctly. We don't have that. So we, on any given day, could go anywhere from 30 to 50% and, just pretend that it is all normal. So, and this started to impact leverage long positions on various derivative exchanges, which automatically liquidated, resulting even more selling. Uh, all of this resulting in a vicious cycle of further liquidation. As Multicoin also pointed out about BitMEX, and I think at this point almost everyone knows what happened at BitMEX, that there was only a 20 million bit side liquidity remained above Bitcoin price of $0, which is like unseen and unheard of. But we had gone to that level. They had to take some time off, correct themselves, and then go back up, and it all survived. Now, like I said before, that Bitcoin's clogged mempools, exchange delays, lack of cross-platform collateralization, prime brokerage, excess leverage, and all of this contributed to market crash. So a market with a very less, or infrastructure in place, and then add a pandemic to it, we hadn't seen this coming. So the other thing is that we, like, um we've seen the growth of DeFi space in past couple of months, I would call it. I won't even call it a year or so. um and we've started seeing you know platforms that are trying to again do borrowing, lending, exchange, be very decentralized exchanges. I wanted to bring up a point. I was a very early employee at Consensus. I was actually hired for Singular DTV ICO, and even back then in 2017, there were dexes coming up, like Singular DTV had launched a dex. So I think that a concept of dex isn't like novel, that just took off like in 2019, and everyone just said that, oh, we all need to exchange our ETH and to help the ecosystem. I think like from from a CFI side, or from the other side of things, we think that we have worked quite a lot to get semi-institutional interest that we've gotten in past a couple of years or so, and that's why Bitcoin dominance is about 59 to 60% on any given day. And we would like the DeFi space to head in the same direction if we want Ethereum to have the kind of adaptability that anyone and everyone would want it to be, aside from the fact that how much of functionality it can support. So just like the crash on the CFI side on March 12th, DeFi had its also shortcomings. Uh, we all know about MakerDAO and how the walls became undercapitalized. The Keeper software was not built to dynamically adjust gas prices in response to network congestion. So miners did not include Keeper liquidation transaction in blocks, and as far as Maker Protocol was concerned, no one was bidding in the collateral liquidation auction. And someone took an advantage of it, decided to bid as low as zero for 8 million of ETH collateral, and succeeded in doing so. This is something that I've taken from Multicoin Research. I've mentioned them already. And then the other thing I wanted to talk about is that this is not the first time that DeFi had seen a hack, like within like last 6 months or so. We've seen the BZXX during the ETH Denver weekend. Price manipulation of Maker on Syntax. LendMe and Uniswap just recently lost $25 million. So again, I'm not saying that there's like some serious shortcomings that cannot come over it. I remember vividly on how there used to be hacks on Binance and Coinbase every now and then back in the day when they were coming more into play in 2016 or 2017 or so. But I think that a lesson that we would like to give out, like traditional shops like us, to other DeFi protocols, that look guys, we're like here to help. So you don't have to do this in isolation and like make it into a very small market. We can help you. At the end of the day, we all have the same goal for these cryptocurrencies to be widely adapted and traded widely. About was, I wanted for everyone in the audience or whoever is watching to know the growing market of Ethereum derivatives market. BTC is currently traded on CME, LedgerX, Backed, Deribit, Binance, and whatnot. But then there's also ETH options. March 12th could have been the end of crypto, but it honestly wasn't, because in the next few days, we started to see bullish activity again with liquidity. And we also noticed crypto decoupling itself from traditional assets. Now, great news for all of us is that, I think this is the time where we all can focus on how to become better. And I think that despite of a lot of traditional infrastructure not being into place for CFI, like regulations, clearinghouses, brokerage, derivatives have been playing a significant part in helping markets mature effectively, and have attracted some serious institutional play as more and more derivative trading platforms come into play. So as I show that, even on May 20th, for even in May 20th, this current month, we've seen about close to like 12 to like 13 million of options being traded on Deribit, which is a very good number given that it only started not like almost less than 6 months ago. So wanted to bring a couple of strategies that everyone should look into. Protective puts through the purchase of put options. Miners, stakers, and investors. I know that there's going to be a lot of miners in the audience right now, can protect themselves from downside price exposure and volatility, which could hamper their treasuries and business operations. Guys, options is one of the best way to protect yourself from downside and volatility if you are trying to trade ETH smartly. Put options, just like for insurance, for other industries, help place a floor on price and dampen overall price volatility, making it more predictable and manageable. It's your shot, it's your call how you decide to put it, your strike price on, where do you think, what's the max amount of risk you could take. It's totally up to your call. Covered calls, options, they generate yield by selling call options against their long token exposure. When a party sells a call option, they get the premium from the sale upfront, often more than 25% annualized. This is your annualized yield on the option size is definitely much more higher than any DeFi protocol that is currently offering. Because it's advised investment strategy, and I'm not out here giving investment advice, but I'm all just saying is that there are better venues to invest your money wisely if you want this ecosystem to grow maturely. Covered calls can help offset operational costs that otherwise would have to be generated by selling crypto, as well as help offset any possible price depreciation. As I mentioned earlier, the liquidations happen as fast as they could. And not a lot of market makers were hurt to a point where they had to close down, shops completely. And, where, a downside investment could have resulted on a 25 million bad trade or anything. So I think that's where the options help with the investment in the current volatile landscape. And then costless collar, by combining a protective put and covered all, an option user in exchange for some upside exposure in token price appreciation. Option users can make the cost of hedge costless, enabling one to obtain downside price protection and price stability for minimum upfront resources. So again, if you have it, you put it up, you decide on your own, in exchange for some upside exposure. Now, where do we all stand, right? Like I said, this is not from an investment advice perspective, but this is from more of our safety and our protection and our downside protection perspective. We see that options can provide downside, smooth out volatility, and generate higher yields than many current DeFi protocols. Key infrastructure players continue to launch and grow. Prime brokerage and custodians like Tagomi, Copper, and Anchorage, fixing the cross-platforms collateralization. Xmargin is an upcoming player that provides cross-marginal solution with no central authority. And then most importantly, connecting DeFi with CeFi. Professional trading desks like Cumberland, B2C2, FalconX, and Jump are well equipped to absorb large market orders with minimum market impact, dampening negative liquidity gaps as observed on exchanges on March 12th. Like I said, we are here to help any DeFi protocol out there that is willing to go on more of a larger scale route, because we think we all are betting against the same thing, our cryptocurrencies, but we all think that crypto has the potential to be a global scale, to be at the global scale. But if we'll continue with like dividing the ecosystem like even much more into smaller parts, and just even focusing on that, focusing our resources on that, I don't think on a global scale we'll ever be able to achieve the unity that we all are aiming to be. So I think we're always there for you guys. We've recently joined Chicago DeFi Alliance, and we'd be mentoring DeFi protocols on market infrastructure and providing them the similar guidance, because at the end of the day we would want less hacks, less bad trades, or less bad reputation coming to our industry, in like whether it's in the DeFi format or NFT format or whatever it is. At the end of the day, we all a big giant happy crypto blockchain family. And I take this rune's statement very seriously, that CeFi and DeFi will eventually merge. As I've said, in the course of past, almost 15 minutes or so, is that we all are aiming for this same unity. We all are aiming for, these crypto assets to grow, to, flourish. And that's why we would want it to, be taken as well as probably Bitcoin or ETH, and many options has been taken on the CeFi side. So we all are striving for the same thing. I also wanted to bring up like one point that I saw while I was researching for this is currently DeFi is only about 1% of what the CeFi activity is, which kind of like says a lot. Like if we were to combine sources, it's going to be a much better play for everyone combined. And by May 2022, DeFi is expected to have about 10 million of users, which is comparatively a still very small number. But again, if all of is combined in one form or the other, if all of this is protective, and if all of this is traded well, I think we shouldn't have any issue with the possible mergers that MakerDAO had initiated. Thank you so much again. I wish I could have taken some questions, but I can. Can I think, okay, perfect. Awesome. Thank you guys. I think that's all from me.